Here to explain what he sees differently about inflation is Michael Darda, the chief economist and macro strategist at Roth Capital Partners. It's good to see you, Mike. And, to me, it feels a little bit like some of the inflation is cost push and some of it's idiosyncratic. But it all seems to be sticking around, longer than we had hoped. So I'm curious how you would explain kind of the broader trends that you see.
Well, Kelly, I think we've made a lot of progress, and I think that's what Powell is going to say this week. If you go back 2 years, we were 350 basis points above the Fed's target on PCE inflation. Now we're 60 to 80 basis points above on a year-to-year basis. And if you just look at the monthly figures, core PCE inflation annualized at 2% or less in 6 out of the last 8 months. So I think that's a pretty good track record in the sense that the Fed was able to do this and avoid what typically happens, which is a recession and a big stock market crash. So, I think you have to give them credit. I was skeptical that they'd be able to pull this off. They're pulling it off. And I think what Powell is going to say is economy has held up better than expected. We've taken the short rates down 100 basis points. We're just going to sort of see what happens from here. And I think it's completely premature. I mean, it's February 10th. No one knows what the situation is going to look like in the fall of this year or in December. So I just think it's a little early to say, okay, all further rate cuts for the year completely off the table. The market's only pricing in about 1.5 cuts now. So, we'll see. The Fed, I think, is going to retain a lot of flexibility here.
Are you surprised that consumers seem as aware as they are about tariffs? You probably saw that data from Friday, inflation expectations. A quarter, a third maybe of respondents cited tariffs as a reason why they think prices are going to be higher. We've seen a lot of pull forward in demand. So I'm curious how that's all going to work through.
Yeah, I'm a little skeptical of some of these surveys with the University of Michigan data. There could be some political biases, and it wouldn't be the first time that we've seen that. So these sudden spikes tend to either be revised away or reversed. We got some data out of the New York Fed today on inflation expectations that looked much better behaved. Now, look, the bond market inflation expectations have moved up pretty considerably since the fall of last year, but they were rolling over hard going into the fall of last year. It looked like the labor market was losing steam rapidly. So the Fed's rate cuts reversed that. And at least, you look at the 10-year horizon for the TIPS market, 240 basis points, that's a good level. That's consistent with price stability. So that means the Fed is doing it right. We shouldn't worry so much about whether there's stability in short-term interest rates. Really what we want is nominal stability in terms of nominal spending and inflation over time. That's the Fed's task, not to just keep the short rate fixed at some level and then have the business cycle go off the rails. So they're basically getting it right here. I hope that can continue.
And what's interesting, Mike, is I think you are like other voices we've spoken to recently. You have more of a bias towards value, towards some of the healthcare stocks, towards the small caps, kind of staying away from the S&P 500 and its dominance with the Mag 7. But if the Fed ends up looking at this and we see job growth slow or, what have you, like you said, but they see stickiness in prices because of tariffs and they don't cut rates more, then wouldn't that be a broader risk to the economy? Wouldn't that be a risk to things like value and small caps?
Oh, no doubt. I think anything cyclical, if the economy stumbles or if the Fed has difficulty in tracking the neutral rate because of these supply side cross currents, that's probably the bigger risk. And I think, anything that is hitched to the business cycle could end up not performing particularly well. But if we go back to the late 90s, early 2000s, the last time we were in a frenzy driven by the technology sector with super high valuations, we saw a 7-year period of outperformance for small cap value stocks in the wake of that, including through a recession period and nearly a 3-year bear market for the S&P 500. And so in my view, this is an area I think that as long as we're committed to a multi-year horizon, which individual investors should be doing, they shouldn't be day trading, in my opinion.
Yeah.
I think it makes a lot of sense.
I even heard